Alrighty, this is the beginner's course on financial markets, stocks, options, futures, and risk management. I want to say before we start, grab a pen, grab a pencil, grab a highlighter, grab a notebook, whatever you need to do, whatever you have, you need to be writing this stuff down to retain the information. I also want to say, if you are not a beginner, you've been trading for a while, you already are well educated on stocks, options, futures, and trading in general, this course is not for you. It's a complete beginner's course. So we're going to start at the very, very basics. If that is you and you've been trading for a while, go to my second step on the 5-step list I have in my Discord, or the third step. Third step is going to be my strategy. Second step is going to be the basics of technical analysis. So still a beginner's course, that's second step. If you're a beginner, I want to take you from knowing absolutely nothing about the stock market and giving you a step-by-step guide to becoming, first of all, a good investor, one, and then a good trader, two. So this is going to be stocks, options, futures, and risk management. Let's get straight into it. This is going to be the course outline. I made this with an idea of it being a 5-day course. So you can split it up into 5 days. It doesn't have to be consecutive days in a row whenever you make time for it. If you do it all in 1 day, awesome. 2 days, awesome. But if you want to split it up into 5 days, that would make the most sense. So that way you retain the information, you can actually take it in, and you don't rush through it. So day one is going to be very, very basics. It's going to start on what is a stock, right? And that's the most basic we're starting. And we're going to get more and more into depth about everything as we go along. So day one, module one is going to be the stock market and all the basics of the stock market. Day two is going to be options trading and everything that has to do with options. Day three is futures, everything that has to do with futures trading. Day four is risk management, and to get you started, pick a broker. And day 5 is the final exam. Let's get started. Module 1, the stock market. Some things you're going to be learning in this module is what is a stock and why do companies issue them. You're going to differentiate between common and preferred stocks, learn how the stock market works, identify key stock market participants, understand basic concepts like supply and demand, market cap, and stock indices, explore different types of investment strategies. You got buy and hold, growth, dividend investing, value investing, etc. You're going to recognize the potential benefits and risk of stock investing, and then know how to open a brokerage account and just place a trade. So what is a stock? At its most fundamental, a stock represents a small piece of ownership in a company. When you buy a stock, you're essentially buying a tiny fraction of that business. So you're part owner of that company. As a shareholder, you become part owner. The ownership isn't just symbolic. It often comes with privileges. For instance, stockholders typically have voting rights on important company matters such as electing the board of directors. Why do companies even issue stock in the first place? Companies will issue stock to raise capital to fund their operations, expand their business, research new products, pay down debt, or other corporate purposes. Right? So it's basically just for them to raise money. IPOs. What is an IPO? IPO is when a private company decides to offer its shares to the public for the very first time. It's called an IPO. This is a significant event for a company as it transitions from a private company to a public company. So it transitions to private investors to public investors, allowing a much wider pool of investors to buy its shares. Common versus preferred stock. Common stock. This is going to be the most prevalent type of stock. Common stockholders typically have voting rights, 1 vote per share, and the potential for higher returns if the company grows, but they are paid after preferred stockholders and bondholders if the company liquidates. If the company goes to zero and the company goes bankrupt, preferred stock owners have first priority. Preferred stockholders usually don't have voting rights though, but they do have a higher claim on the company's assets and earnings than common stockholders. This means they receive dividends before common stockholders do, and in the event of liquidation, like I just said, they are paid before common stockholders. Preferred stock dividends are often fixed, so they don't change. Dividends are lump sum payments that can be paid every month, quarter, or year, and it's kind of like a way of showing appreciation for holding their stock. It's a bonus for stockholders to hold the company. It's an incentive for investors. Lesson 2, how the stock market works. So you have the primary market and you have the secondary market. Primary market is where new stocks are issued for the first time. When a company goes public via an IPO, it sells its shares directly to investors through an underwriting process managed by investment banks. The company receives the money from these sales. So everybody that buys stock on that initial public offering, all that money goes to the company, and they can use it however they like. Now, the secondary market is where these companies will go after the primary market. So they raise capital for the initial public offering, and then after that, they go to the secondary market. Most stock trading occurs in the secondary market. This is where investors buy and sell existing shares from each other. The company that originally issued the stock does not receive money from these transactions. They only receive money from the initial public offering. From there, they hold shares of the company. So if that stock continues to go up, they do make money, but they don't get that money directly. The two biggest exchanges in the world is the NYSE and the NASDAQ. NASDAQ's in Chicago, New York Stock Exchange obviously in New York. It's one of the oldest and largest stock exchanges in the world, known for its floor trading. So everybody back in the day used to trade on the floor. Obviously there was no computers. The NASDAQ is a fully electronic exchange. It lists many technology and growth companies, and it's entirely computerized. Role of brokers and market makers. Brokers. These are financial intermediaries that facilitate the buying and selling of stocks on behalf of investors. When you place an order to buy or sell a stock, your broker executes that order on the exchange. Now, think about if you want to buy apples. You go to the grocery store and buy an apple. But where does the grocery store get that? They get it from the supplier. So their grocery store is essentially the broker. Instead of you going directly to the supplier of apples to buy an apple, you go to the grocery store. If you want to buy a stock, you don't go directly to the exchange, you go to the broker. Market makers. These are financial firms or individuals who stand ready to buy and sell specific stocks at publicly quoted prices. They provide liquidity to the market. Liquidity is basically volume. It's orders. So they provide orders to the market by continuously offering both a bid price and an ask price. The difference between these two prices is their profit. So every time you sell a stock, there's somebody buying that stock from you. Every time you buy a stock, there's someone selling that to you. Sometimes there's a high pressure of sellers compared to buyers and vice versa. So market makers, if there is an imbalance, they try to balance this out so that way everyone that's trying to sell can find a buyer, which half the time you sell is going to be a market maker buying because they provide most of the liquidity in the market. And they make money because there's always a bid price and an ask price. So the bid is going to be the lower price. It's going to be the price that they're willing to buy at, and the ask is going to be the price they're willing to sell at. So what they do is they'll buy it at the bid price and then immediately sell that at the ask price for 2-3 cents profit. So they do profit. It's a very small margin, but they're there to provide liquidity and to help fulfill orders, basically. Supply and demand. How prices are determined. Stock prices are fundamentally driven by the classic economic principles of supply and demand. If there's high demand for a stock, more buyers than there are sellers, then its price rises. If there's low demand or high supply for a stock, then its price will fall because there's more sellers than buyers. News, company earnings, economic data, and investor sentiment all influence supply and demand dynamics. Now, supply and demand is a classic economic principle and is just as basic and important in the stock market. It drives prices up and down. Lesson 3, key concepts and terminology. So what is a share? A share is a single unit of ownership in a company. If a company has 100 million shares outstanding and you own 1,000 shares, then you own 0.001% of the company. Dividend, a portion of a company's profits that is periodically distributed to its shareholders. Not all companies buy dividends, but those that do often appeal to income-focused investors. Dividends can be paid quarterly, semi-annually, or annually. Capital gain, the profit you make when you sell a stock or any asset for a higher price than you paid for it. If you buy a stock at $50 and sell it at $60, then you have a $10 capital gain per share. And then the opposite for capital loss, if you sell it for less than you paid. Market cap, market capitalization. This is the total value of a company's outstanding shares. It's calculated by multiplying the current share price by the total number of shares outstanding. Market cap is often used to classify companies, large, mid, small cap companies. So an example, if a company has 100 million shares outstanding and its stock price is at $50, its market cap is $5 billion. So you just times the shares outstanding by the stock price. Stock indices. A stock index is a measure of the performance of a group of stocks designed to represent a specific market or segment of the market. They act as benchmarks for overall market health or specific sectors. So look at a stock index as almost a basket of fruit, and each fruit represents a company. Instead of buying each individual fruit, you could just buy the whole basket. So you own all the stocks instead of buying each stock individually. You own them all within one purchase of a stock index. The S&P 500 stock index owns the top 500 largest publicly traded companies in the United States. So it's a broad gauge of the United States stock market. The Dow Jones Industrial Average, otherwise known as just the Dow, tracks 30 large publicly owned companies based in the United States, often seen as an indicator of the health of the United States industrial sector. So it's the 30 largest industrial stocks. The NASDAQ is going to be the tech index. It is a weighted index of all common equities listed on the NASDAQ stock market, heavily weighted towards tech and growth companies. So typically you'll see the Dow move the slowest, the S&P 500 move the second slowest, and the NASDAQ move the fastest, because the NASDAQ is where the tech is or where the growth is. And obviously, the past 25 years, it's been all about tech companies. Earnings per share and price to earnings ratio. These are fundamental metrics used to analyze a company's financial health and valuation. Earnings per share is a company's net profit divided by the number of outstanding shares. Now, this will tell you how much profit a company makes for each share of stock. So if you're looking to buy a technology stock, you want to compare each EPS to other technology stocks and find out which company has the highest EPS. That means they're making the highest earnings per share. Price to earnings ratio is similar. It's calculated by dividing a company's current stock price by its EPS. It tells you how much investors are willing to pay for each dollar of a company's earnings. A higher PE often suggests investors expect higher future growth. So if a company like, I'm sure many of you heard of PLTR, Palantir, its growth metrics are insane right now, so they're valued at a much higher PE ratio than every other stock you'll find in the S&P 500. Lesson 4. There's going to be types of stocks. Number 1 is growth stocks. Shares of companies that are expected to grow at a faster rate than the overall market. These companies typically reinvest their earnings back into their business rather than paying dividends. Investors buy them for potential of significant capital appreciation. Examples often include tech or biotech. So growth stocks are just companies that are expected to grow at a very fast amount, 50 to 100% plus year-over-year revenue and year-over-year earnings. Dividend stocks, shares of companies that regularly pay out a significant portion of their earnings as dividends to shareholders. These stocks are often from mature, stable companies in sectors like utilities, consumer staples, or real estate. Investors buy them for the steady income stream. So if you have $1 million, $2 million in a stock portfolio and you only invest in dividend stocks, you can collect over $100,000 a year or more, $200,000, $300,000 in some cases a year, from a $1 to $2 million stock portfolio. So that's why people love dividend stocks. You can get a constant, steady income, but your percent each year is going to be much lower than growth stocks. So growth stocks, you might get 50, 60, 70% year over year if you're a really good growth investor. Whereas dividend stocks, you might get like 4 to 10% a year. And 10% is on the high side, but it'll give you that steady income. So every quarter, every month, or every year, you will get steady income stream from dividend stocks. Value stocks, shares of companies that are believed to be trading below their intrinsic value. Intrinsic value is basically the true value of the company. And everyone's intrinsic value for a company may be different, but there is only one true intrinsic value. Value investors look for companies that might be undervalued by the market or have strong fundamentals but a low stock price. They aim to profit when the market eventually recognizes the true value of the company. Warren Buffett was so good at value investing because he was often right about a company's intrinsic value. Blue chip stocks. These are shares of large, well-established, financially sound companies with a long history of consistent earnings and reliable performance. They're often leaders in their respective industries and are generally considered less risky than smaller, less established companies. Examples include companies like Coca-Cola, Apple, and Johnson & Johnson. Lesson 5, long-term investing strategies. A long-term investing strategy where an investor purchases stocks with the intention of holding them for an extended period, regardless of short-term market fluctuations. The goal is to benefit from long-term capital appreciation and dividends. This strategy minimizes transaction costs and the need for constant market monitoring, but may provide lower returns than other strategies. So this is the easiest strategy in the world. You literally buy a company and you hold it, just like it says. Growth investing. This strategy focuses on investing in companies that are expected to grow at an above average rate, even if their current valuation seems high. Growth investors are willing to pay a premium for companies with strong potential future earnings and revenue expansion. This approach gives the highest risk as well as the potential for the high returns. Now, I would not recommend growth investing as a beginner. You have to be well versed and you have to have market experience to know when a company is running out of steam. Because with growth companies, they typically will give really high returns for a while, but when they run out of steam, they're gonna see a big pullback, maybe 50-60%. So you got to know when to get out as well. Value investing. This strategy involves seeking out stocks that appear to be trading for less than their intrinsic value or book value. Value investors believe that the market sometimes misprices stocks, offering opportunities to buy good companies at a discount. They conduct thorough fundamental analysis to identify these undervalued assets. So I know we kind of just went over these here, but I wanted to go over investing strategies as well because they're a little bit different. Buy and hold. You can buy and hold any of these companies. Lesson 6, benefits and risk of stock investing. The benefits are obviously capital appreciation, so if the stock goes up, and 2, dividends. Capital appreciation, the primary benefit is the potential for your investment to increase in value over time. If the company you own stock in grows and becomes more profitable, its share price will rise, leading to capital gains when you sell. Dividends, many companies distribute a portion of their profits to shareholders as dividends, providing a regular income stream. Risk of capital loss, obviously, if the stock goes down, you lose your money. It's kind of obvious. Another thing most people don't talk about is market volatility. So let's say you want to make a purchase on your house, you want to make a purchase, buy a car, a big purchase in your life. Now, if the market at that time is down, you don't really want to take it out. If anything, you want to put money back into it because when stocks are down, that's when you want to buy. Buy low, sell high. Obviously, most basic rule of thumb in the market. Now, it's easy to say, but it's hard to do because at the time when your stock portfolio is down and you're losing money, people don't like losing money and they get scared and they sell and the fear gets the best of them. So market volatility is a big thing. So risk of capital loss, the most significant risk is that the value of investment can go down. If the company performs poorly, its stock price could fall and you might sell it for less than you paid, obviously incurring a loss. Market volatility, stock prices can fluctuate significantly and rapidly due to various factors like economic news, company performance, and geopolitical events or investor sentiment. While volatility can create opportunities, it also exposes investors to the risk of sudden downturns. It's crucial to understand that past performance is not indicative of future results. Lesson 7. Getting started with stock investing. Opening a brokerage account. To buy or sell stocks, you need an account with a licensed brokerage firm. These firms provide the platform and services necessary to access the stock market. You'll typically need to provide personal information, verify your identity, and link a bank account. Placing a buy and sell order. Market order. In order to buy or sell a stock immediately at the best available current price. So if you use a market order, it's going to fill you immediately, but it might not give you the price that you want. Limit order. In order to buy or sell a stock at a specified price or better, you set a maximum price you're willing to pay to buy or a minimum price you're willing to accept to sell. So a limit order, if you use it, will fill you at the exact price that you want to get filled at. So it's nice. You can set that limit order, forget about it. If the stock comes down and hits it, you buy it. If the stock goes up and hits it, you can sell your stock. So this is an example. If you want to buy 10 shares of Apple stock, you log into your brokerage account, search for Apple, click buy, enter 10 for the quantity, and select market order. It'll show you the current price, and once you confirm it, the order will be executed almost instantly at the best available price. In my opinion, the best brokerages for long-term investing are Fidelity, Robinhood, and Charles Schwab. They're very well known, they're very reputable, and it's a good place to park your money. Now, if you're completely new to the financial markets and you want to get started with long-term investing, the simplest and easiest way to go is to buy the S&P 500 index. That'll be ticker symbol VOO or SPY. Reoccurring investments weekly or monthly is recommended, and the best time to start is now. Don't wait. I don't care if the market's at all-time highs, all-time lows. It doesn't matter. Just start today. Into module 1. You did it. That's it. Module 1 is over. You're just taking your very first step on your journey toward understanding the financial markets and ultimately financial freedom. In Module 1, you've unlocked the foundational knowledge of the stock market. You now understand what a stock truly represents, which is a piece of ownership in a company. You've explored how the stock market operates, from IPOs to the secondary markets. You've grasped key concepts like market cap, dividends, and capital gains. And most importantly, you begin to see the incredible opportunities of stock investing. This isn't just about learning definitions, it's about building a solid base that will empower you to make more informed decisions about your money. You got to get a good foundation. So this is just the foundation. You're getting the basics out the way. Now, I built a little quiz. Let's see how much knowledge you've grasped. So I want you guys to pause the video right here. Write all these answers down. Write what you think is correct. And then I'll go through them with you. So pause this video and go ahead and do that. All right. Now that you pause the video, you got all your answers. Let's go over it. Question 1. What does buying a stock primarily represent? It's going to be B, a piece of ownership in the company. Question 2. When a private company sells shares to the public for the very first time, what is this process called? Initial public offering, IPO. It's going to be the very first time a company sells any shares, and they're going to collect all the money from it. Question 3. Which of the following is a payment made by a company to its shareholders, typically from its profits? Dividend. It's going to be C, dividend. Question 4. If you buy a stock for $50 and later sell it for $65, what have you realized? Easy one. Capital gain. Question 5. Which type of stock typically gives shareholders voting rights and the potential for higher returns, but has a lower claim on assets in case of liquidation? This might be the hardest one for you guys, but once you get it, it's really easy. It's going to be common stock. So you have the potential for higher returns, but if the company goes to zero or the company goes to bankrupt, you have the lowest claim on your assets, which rarely happens. All the stock people buy and all the stock that you know of is most likely going to be common stock. So it's not really important, but it is common stock. So that is the end of Module 2. We are going to go ahead and get into options trading now. And that was quick. So if you guys don't want to split this up into 5 days, let's go ahead and jump right into options trading. Module 2, options trading. Learning objectives. Define options as derivative contracts. Derivative means it's based on something. Understand the core concepts of call and put options. Identify the key components of an options contract. Differentiate between buying and selling options. Explain basic option strategies like long calls and long puts. Recognize the leverage and risk associated with options trading, and understand the concept of in the money, out the money, and out of the money. Intro to options. What are derivatives? A derivative's value is derived, so it comes from, an underlying asset such as a stock, bond, commodity, currency, or index. You don't actually own the underlying asset directly, but you own a contract related to it. Options are a type of derivative financial instrument. So instead of buying, let's say, Apple stock directly, and you want leverage on it, you would buy an Apple option contract. And we'll get deeper into this. Options, the right but not the obligation. This is the most crucial distinction of an option. An option contract gives the buyer the right but not the obligation to buy or sell an underlying asset at an agreed upon price on or before an agreed upon date. The seller of the option has the obligation to fulfill the contract if the buyer chooses to exercise the right. Now, if this sounds crazy and you're like, what the hell is he talking about? Just bear with me. We'll go deeper into it. Why trade options? So, why even trade options? I'm going to give you 3 reasons why people trade options. 1 is speculation. Options can be used to bet on the future price movement of an underlying asset with high leverage. As day traders, speculation is the only way we use options, right? So you're taking a trading course right now. It's a stock course and a trading course. So as day traders, me and you are only going to use options to speculate. We're not going to use it to hedge. We're not going to use it to generate income from selling options, and that's a whole different story. Don't even worry about that for now. But we're just going to use options to speculate on price movement of, let's say, Apple stock, Google stock, Amazon stock, etc., Tesla stock. Hedging. Investors can use options to protect existing stock positions against potential losses. So big hedge funds or even people like me and you, if we have, let's say, $100,000 in Apple stock, then we can hedge our position with option puts, and that means if stock goes down, we make money on the option contracts, and that kind of covers some of the losses we will take on our investment. Income generation. Selling options can generate premium income, though this comes with obligations and potentially unlimited risk in some cases. So don't worry about income generation, but that is another reason why people trade options. Lesson 2. Call options. Call options are going to give you the right to buy. So a call option gives the buyer the right to buy a specific number of shares, 100 shares per contract. So every contract that you buy correlates to 100 shares of that stock of an underlying asset at a predetermined price on or before a specific date. When to buy calls. You would buy a call option when you believe the price of the underlying asset will increase before the option's expiration date. If the stock price rises above the strike price, your call option becomes more valuable, obviously, because now you can buy the stock for less than it's worth at the time. So this might help you if you're a little confused or a little lost. You're like, Waylon, what the fuck are you talking about? This is going to help you out a little bit. Profit and loss scenarios for calls. Maximum loss. The maximum loss you can incur when buying a call option is the premium you pay for it. If the stock price doesn't rise above the strike price, by expiration, the option expires worthless and you lose your initial investment. So every option contract has a premium. The premium is how much the option contract is worth. So that's what you're going to pay for the contract. And that's the max you can lose. You can't lose more than what you pay in premium. But your potential profit is theoretically unlimited. So if the stock goes up, it can go up forever, theoretically. So your potential for profit is unlimited, while your potential for loss is capped at 100%. So you can take 100% loss, but you can make 200, 300, 400, 500, 1,000, 2,000% gain on your investment. So that's why people love options, because it gives you a lot of leverage. So for example, let's say it's January 1st, 2025, and Bob thinks the price of Apple stock is going to go up from $200 a share to $220 a share within 1 month. He checked the options market and chose this particular option contract. So he chose the Apple 2/125, 2/10 calls at $3 a piece. So Apple is going to be the underlying asset. The expiration date is February 1st, 2025, because he believes it's going to go up within 1 month. So he chooses 1 month expiration. The strike price is 210. Now this is interchangeable. He could have bought a 200 strike price, 205, 210, 215, 220. It doesn't really matter, but that's just what he chose in this scenario. The type of option is a call because he believes it's going to go up. So remember, you buy a call when you think the price of a stock is going up, and you buy a put when you think the price of a stock is going down, because puts go up in value when stocks fall, and calls go up in value when stocks go up. And he bought it at $3. That, remember, that'd be times 100, so he paid $300 for this option contract. Now let's get into puts. Like I just said, a put option gives the buyer the right to sell a specific number of shares of an underlying asset at a predetermined price on or before a specific date. When to buy puts, obviously, is opposite of calls. You buy puts when you think a stock is going to go down. Let's look at another example, but this time for puts. Let's say it's still January 1st, and Bob, while he thinks Apple will go up, he thinks CVX, Chevron, will go down from 150 to 130 within 1 month. He looks at the contract chain for CVX, and he chooses this particular contract. He chooses the February 1st, 2025, because he believes it's going to go down within 1 month. So he chooses 1 month out expiration date. That's when the option contract will expire. The strike price he chooses is 140. Again, this could be a 130 strike price, 140, 145, 150. Doesn't really matter as long as it's in that general area. Type of option is a put because he believes the stock price is going to go down, and the premium he paid is $186 for that contract. Now, some key options terminology. Underlying asset. This is the financial instrument that the option contract is based on. So if you're buying an Apple call, the underlying asset would be Apple. Strike price, the predetermined price at which the buyer of the option has the right to buy for a call or sell for a put of the underlying asset. Expiration date, the date on which the option contract expires. After this date, the option is no longer valid and the right to buy or sell the underlying asset ceases to exist. So the expiration date is when the option contract is gone, it is forever gone, and that is the date that it will expire. Contract multiplier. Standard options contract represents 100 shares of the underlying stock. So if you buy one call option for NVIDIA stock, you control 100 shares of NVIDIA. This is a key factor in how options offer leverage. So it gives you a lot of leverage, which means you can make a lot more than just buying the actual share price. Or you can lose a lot more. Premium, the price the buyer pays to the seller for the options contract. This is the cost of acquiring the right. So if the premium is 2.0, the contract costs $200 because you times that by 100. Remember, every single option contract is times by 100 for its actual price. So an easy way of doing this is just get rid of the decimal point. So if it's 2.83, it's $283, etc. This is a little bit more advanced, and you don't really need to know this, but I wanted to cover it anyways. It's going to be going over intrinsic value and time value. So in the money, at the money, out the money. These terms describe the relationship between the underlying asset's current price and the option's strike price. For a call option, when the underlying asset's price is above the strike price, it is in the money. For example, if Apple stock is at $105 and the option strike price is $100, that means it's in the money and it has more value. It's going to move a lot better than something out of the money. For the put, is exactly the opposite. It's when the asset's price is below the strike price. So Apple stock is at 95 and the strike price is 100. Now it's below it, which is good for a put because you're making money if the stock falls. In the money options have intrinsic value, meaning they have immediate value if exercised. Now, as day traders, we're never going to exercise the option contract, so it doesn't matter. At the money, when the underlying asset's price is equal or very close to the strike price. So typically when we're day trading, we're going to just choose the closest at the money option because that's the option that's going to move the best. Out of the money, this is going to be when the underlying asset's price is below the strike price for a call. So let's say Apple stock is at $95, the call option strike price is at $100. That means it is out of the money. It still needs to go for another $5 for it to be at the money. For a put, when an underlying asset's price is above the strike price. So Apple stock is at $105, the put option strike is $100. That means you still need another $5 drop to be at the money. And then anything below that is going to be in the money. Out the money options have no intrinsic value. Their entire value is time value because it technically has no value if you exercise the contract, meaning you buy the shares of the contract at the strike price. But like I said, we're day traders, so we'll never be exercising the contract anyway. Theta, otherwise known as time decay. This is a crucial concept. Options have a finite lifespan. As a contract approaches its expiration date, its time value erodes, meaning its premium decreases. This phenomenon is known as time decay, or theta. Theta will increase as the option nears the expiration date. This is why trading 0DT options are considered risky, because theta is really going to be working against you. If you don't get the move in your favor immediately, theta is really going to eat away at your contracts and decay the price of them. So you will lose money a lot quicker. And that is the end of Module 2. Now, bear with me. If you're like, what the fuck is he talking about? I still don't know what the fucking option contract is, how exactly it works. Don't worry. I got some good news for you. Day trading options and futures, it's all about the premium. So we do not care about exercising the contract. All we care about is the difference in the premium price from when we buy it and when we sell it. So honestly, you really don't even have to know anything about an options contract in order to be a profitable day trader. So let's get into it. Now that we covered options trading, and before we delve into futures trading, it's crucial to understand a key difference in how day traders approach these instruments compared to long-term investors. For a day trader, the goal is to profit from very short-term price movements. This means you're typically not interested in actually owning the underlying stock, commodity, or index, nor are you interested in fulfilling the obligation to buy or sell at a future date. Instead, as a day trader, your focus will almost entirely be on the premium of the options contract or the value fluctuation of the futures contract. Here's why. Options premiums. When you buy an options contract, you pay a premium for it. This premium changes constantly throughout the day based on factors like the underlying asset's price, time remaining until expiration, and market volatility. As a day trader, you're buying an option contract when you expect its premium to increase. Whether it's a call or a put, doesn't matter. You're just expecting the price to go up of the contract. And you're selling it for a profit, and you think you've gotten the most out of it. So you'll close your position, you'll sell the option you bought before the contract expires. You will never wait until expiration to exercise your right to buy or sell the underlying shares. Why? Because you're looking for quick profits from the premium's movement, and exercising would involve a much larger capital commitment and different logistical considerations. So we're just focusing on the price of the premium. Think of it like this. Imagine you buy a reservation for a highly anticipated new restaurant for $50, knowing that demand for reservations is high and they might sell for $100 closer to the date. You're not planning to eat at the restaurant yourself, you're planning to sell a reservation for a profit. So it's just like people buying Yankee tickets and then selling it to them on the side of the Yankee Stadium. And then same thing with the futures contract. Day traders are focused on the daily fluctuations in the contract's value, which is driven by the underlying asset's price. You enter a futures contract expecting its value to move in your favor. Your profit or loss is realized from the change in the contract's value, which is settled every day. You will never hold a futures contract until its expiration with the intention of taking or making physical delivery of the underlying asset, like barrels of oil or bushels of corn. Day traders close their futures positions well before the expiration, often within the same trading day, to capture small price movements. So in essence, for a day trader, options and futures are tools for speculating on price direction using leverage, with the primary goal of profiting from the contract's value change, not from the actual exercise or delivery of the underlying asset. This allows for quick entries and exits, aiming for smaller, frequent gains. This also means that although you should be educated on all the intricacies and details about how futures and options work, you don't necessarily need to fully understand them to be a profitable trader. Though it will help you grasp the concepts and understand the derivatives at a higher level, the only thing you really need to understand is that you are profiting from the change in premium for options trading and the change in the underlying asset's price for futures trading. You will never, ever, ever exercise your right to buy or sell when day trading. So it's all about the premium. It's actually really simple. Now that that's over with, you might be like, whew, I'm glad because I did not know how an option contract works. All you need to know is that we are profiting on the change in the price of the premium. So let's take a quiz. Again, pause the video here, go through the questions, write your answers down, and then I'll go through them. So question 1, a call option gives the buyer the right to do what with the underlying asset? So it's B, buy it. Question 2, if you believe the price of a stock will go down, which type of option would you buy? A put option. What is the term for the price at which the buyer of an option has the right to buy or sell the underlying asset? So what is the price at which the buyer? It's the strike price. Question 4, what is the maximum amount of money you can lose when you buy a single options contract? B, the premium you paid. That is the max loss you will lose. Question 5, a day trader who buys an option contract is focused on profiting from what? The contract's change in premium. Yes, remember that. This is the most important part. We're just profiting on the change in the premium. Now, Module 3, futures trading. Obligations and leverage. Some learning objectives are define futures contracts as standardized agreements, understand the difference between futures and options, identify common underlying assets for futures contracts, explain the concepts of going long and going short in futures, Understand leverage and margin in futures trading, recognize the mark-to-market process and margin calls, and be aware of the significant risks involved in futures trading. Lesson 1 is the intro to futures contract. What is a futures contract? It's the obligation to buy or sell at a predetermined price on a future date. A futures contract is a standardized legal agreement to buy or sell a specific commodity or financial instrument at a predetermined price at a specific time in the futures. So unlike options, futures contracts carry an obligation for both the buyer and the seller. The buyer is obligated to take the delivery of the underlying asset on the expiration date, and the seller is obligated to deliver that underlying asset on the expiration date. Standardization of contracts. Futures contracts are highly standardized by exchanges. This means they have fixed specifications regarding quantity, quality, and delivery location, and the method of delivery. So for example, on the quantity, when you're trading crude oil futures and you want to exercise that futures contract, that's going to be 1,000 barrels of crude oil per contract, or 5,000 bushels of corn per contract. The quality is specific, so it has to be of a specific quality, and the delivery location and method is always predetermined. Now, what is the purpose of futures contracts? Now, remember why I'm going through this. As day traders, all we really care about is the change in value of the futures contract. We're never going to exercise it. So we don't have to worry about the quantity, the quality, delivery location, and method. It doesn't matter. We're just speculating. But the real purpose of futures and why were they first created were for farmers and producers, right? So the purpose, hedging and speculation. Hedging. This is the original purpose of futures. Producers, like farmers and oil companies, or consumers like airlines and food manufacturers, use futures contracts to lock in prices for future transactions, thereby reducing their risk of adverse price movements. For example, a farmer can sell wheat futures to lock in a price for their harvest. That way, before harvest comes around, they already know what they're going to sell the wheat for and how much money they're going to get for it. Speculation. Now, this is me and you. Traders use futures to profit from anticipated price movements of the underlying asset. They take a position, long or short, based on their belief about where the price will go, without intending to take or make physical delivery. We don't care about getting the corn. We don't care about getting the oil. All we care about is money. That's why we're trading, okay? Lesson 2, key characteristics of futures. Underlying assets. Underlying assets are either 1, a commodity, or 2, a financial instrument. So some commodities could be agricultural products like corn, wheat, or soybeans. It could be energies like crude oil or natural gas. And it could be metals, gold, silver, and copper. And there's much more that I didn't name. That's just some of the big ones, to name a few. Like another one is live cattle. There's literally live cattle futures that you can go and trade, which is pretty cool, but also has no volume and you won't make any money for it, but it's cool that it's out there. Financial instruments, stock indices, such as the SP 500 and the NASDAQ, which we talked about. SP 500 is the top 500 companies in the United States, and the NASDAQ is the top 100 companies in the top 100 tech and growth companies in the United States. It's also currencies like the euro, the Japanese yen, the dollar, etc., and interest rates, so treasury bonds, a 10-year treasury bond, 30-year treasury bond, and so on. Contract specifications, tick size, and multiplier. Tick size is the smallest allowable price increment for a futures contract. So for example, for Apple, the smallest increment is 1 cent. So it can go from 100 to 100.01. For futures, typically for ES, the smallest price, which is the SP 500 future, is ES. The smallest price movement is 0.25 cents. And that's just because it wouldn't make sense for exchanges to put all these orders in at 1 cent intervals. There would be too many orders coming in. So they limited it to 25-cent intervals. And it's different for every futures contract. Multiplier. Each tick movement translates to a specific dollar amount due to a contract's multiplier. For example, the SP 500 futures contract has a multiplier of $50 per point. If the index moves 1 point, the contract value changes by $50. Understanding the multiplier is crucial for calculating profit or loss. So I only trade ES and NQ, and so I have to know how much I'm going to lose on a trade before I get in. So I have to know the multiplier of ES and NQ. And corn's going to be different, gold is going to be different, Bitcoin is going to be different, all these are going to be different. So you have to understand how much that futures contract moves per tick or per point before you buy or sell it. And last thing is expiration dates. Futures contracts have specific expiration dates, usually monthly or quarterly. At expiration, the contract is either settled by physical delivery of the underlying asset, or more commonly for financial futures, by cash settlements. But again, we won't have to worry about that because we're just looking for the change in value. Now, what is the difference between going long and going short? Long futures is betting on the price to increase. When you buy a futures contract, you are taking a long position. You are obligating yourself to buy the underlying asset at the agreed upon price on the future date. You take the position if you believe the price of the underlying asset will increase by the expiration date. And vice versa, for short futures, you're betting on the price to decrease. When you sell a futures contract, you are taking a short position, so you are obligating yourself to sell the underlying asset at the agreed upon price on the future date. You take this position if you believe the price of the underlying asset will decrease by the expiration date. This allows traders to profit from falling markets just as easily as from rising markets. Lesson 4, leverage and margin in futures trading. So what is leverage and what is margin? Initial margin is basically a good faith deposit. To enter a futures trade, you don't pay the full value of the contract. Instead, you deposit a relatively small amount of money called the initial margin into your brokerage account. This is a good faith deposit to ensure you can cover the potential losses. It's typically a small percent, like 5 to 50% of the total contract value, and that is why futures are very highly leveraged, because you don't need a lot of money, but you can make a shit ton of money with it. Maintenance margin and minimum required equity. Once a position is open, your account equity must stay above a certain level called the maintenance margin, and this is typically a bit lower than the initial margin. Now, every broker out there is going to have a different initial margin and maintenance margin that they require, and you can find ones with very, very little margins. So you can start a futures account with as little as $1,000, and you can build that up from there. I would recommend at least $2,000, but you can start with as little as $1,000. Or just trade prop firms, right? That's why they're out there. That's why prop firms are so big, and we'll go over prop firms later. So to go into more detail, margin calls. When your account falls below maintenance margin, you get a margin call. You never want to see a margin call. This means you get liquidated. This means you lost a shit ton of money, and that is never a good thing. If the market moves against your position and your account equity falls below the maintenance margin level, your broker will issue a margin call. This is a demand for you to deposit additional funds into your account to bring it back up to the initial margin level. If you fail to meet a margin call, your broker can liquidate your position, and it could be a huge loss. Magnified gains and losses due to leverage. So because you only put up a small percentage of the contract's total value as margin, small price movements in the underlying asset can result in large percentage gains or losses on your initial margin. So you can make a shit ton of money or you can lose a shit ton of money with futures. It's highly leveraged. This leverage is the double-edged sword of futures trading. It can amplify profits, but it can also lead to rapid and substantial losses that exceed your initial deposit. Mark-to-market settlement. This is another thing with futures that are very distinctive of futures contracts. So daily settlement of gains and losses. Futures contracts are marked to market daily. This means that at the end of each trading day, your account is credited with any gains or debited for any losses from your open positions based on the day's closing price. So unlike options, if you never sell the options contract and it goes into the next day, it doesn't give you a gain or a loss, but futures will, depending on if you're up or down. But if we are day trading, then you never want to be swinging a position. That's why you are day trading. You are not swing trading. You never swing a position overnight, so you should never have to worry about to market settlement. It'll settle on the same day because obviously you're going to sell your position on that day because you're day trading. So, but if you were to swing trade futures maybe a year from now, 2 years from now, once you get some knowledge, this is how it will work. So, impact on account balance. If you have a winning position, your account balance increases and funds become available to withdraw or use for other trades. If you have a losing position, funds are deducted from your account, and if it falls below the maintenance margin, you'll receive a margin call. This daily settlement mechanism means you'll realize profits and losses every day, even if you haven't closed your position. Now, what are the risks of futures trading? Obviously, it's highly leveraged, so you have the potential for rapid, significant losses. That's why risk management is so important, and that's what we're going to go over in the next module. This is the most critical risk. While leverage can lead to substantial profits from small price movements, it also means that adverse price movements can quickly lead to losses that exceed your initial margin deposit. You could lose more money than you have in your account if you are not careful. Liquidity risk. While major futures contracts are highly liquid, some less actively traded contracts might have wider bid-ask spreads or difficulty in getting orders filled quickly at desired prices, especially during volatile periods. So we won't really have to worry about this because you're only going to be trading ES or NQ or maybe gold at some points in your beginning. So you won't have to worry about this. You're not trading live cattle. You're not trading corn futures, so it doesn't really matter. Market volatility. Futures markets can be extremely volatile, particularly for commodities or during major economic announcements. Sudden price swings can lead to rapid gains or losses. Importance of strict risk management and position sizing. Position sizing. Carefully determining how many contracts you trade based on your capital and risk tolerance. Never over leverage. Use stop loss orders. So using stop loss orders to automatically close the position if it moves against you by a predetermined amount, so it limits your potential loss on the trade. Understanding margin requirements. You should always have sufficient capital to meet initial and maintenance margin requirements and potential margin calls. So always have a good amount of money in your account. Don't use your whole account. Don't use 50% of your account. Typically use risk on each trade about 5% of your account. And we'll go over that on the next module. And that is the end of Module 3. You have completed futures trading. In this concept, you've learned the difference between a right and an obligation. You've learned the mechanics of leverage and margin, which can amplify both profits but also losses. And you've learned the importance of daily mark-to-market settlement process. Understanding futures is a major step in becoming a well-rounded financial market participant. Now you have knowledge on stocks, on options, and on futures. Next, we'll bring it all together, focus on the most important topic of all. That is how to manage your risk and build a plan for your financial journey. But first, you already know what time it is. Let's see how you do in this quiz. Again, read these questions, write down your answers, and then we'll go over them. Question number 1. What is the primary difference between a futures contract and an option contract? Futures give you the obligation to buy or sell, while options gives you the right, but not the obligation, so it's C. So if you picked A, I kind of get if you did, but futures aren't just for commodities, they're also for financial instruments. So the euros, the dollar, the British pound, you can also trade the S&P 500 indices, obviously ES, and the NASDAQ. So it's not just for commodities, but options are just for stocks, right? Question 2. If you believe the price of crude oil will decrease in the future, what position would you take in the futures market? You would go short. If you think something's going to decrease, you go short. Increase, you go long. So it's B, go short. Question 3. What is the small amount of money you must deposit to enter a futures trade called? That is going to be the margin. C. Question number 4. What does it mean for a futures contract to be marked to market daily? It is B. It means your profits and losses are settled and added to or subtracted from your account every single day. Question number 5. A futures trader who is forced to deposit additional funds into their account because of a losing position has received what? A margin call. That is what none of us ever want to receive. And you've made it to the last module. Module 4, risk management. getting started responsibly, this is going to be the most important module in my opinion, because if you can't manage risk, then you can't trade. So learning objectives are understanding the importance of risk management in all trading, learn basic risk management techniques so like stop loss orders and position sizing, recognize the emotional aspects of trading and investing, understand the importance of continuous learning and developing a trading plan, and identify resources for further education. Lesson 1, risk management. This is the golden rule. Why risk management is essential for long-term survival. In the financial markets, especially with options and futures, because they're highly leveraged, the potential for high returns often comes with equally high risk. Without a robust risk management strategy, even a few bad trades can decimate your capital, making it impossible to continue trading. Risk management isn't about avoiding losses entirely, because losses are inevitable, you will lose, but it's about managing and limiting them to protect your capital and ensure you can stay in the game for the long run. It's the difference between a single mistake ending your trading journey or blowing your whole account and learning from it to become a better trader. Defining your risk tolerance. So before you place a trade, you need to honestly assess your personal risk tolerance. How much money are you truly comfortable losing on a single trade or over a period of trades? And what kind of emotional impact would a significant loss have on you? You need to understand these things before you place a trade to understand how much you want to risk on every trade. Your risk tolerance should influence the type of assets you trade and the amount of capital you allocate to speculative ventures. Never trade with money that you cannot afford to lose. Lesson number 2, basic risk management tools. Stop loss orders. A stop loss order is an instruction to your broker to sell a security when its price falls to a specified level. Its purpose is to limit a trader's potential loss on a position. So how do they work? If you buy a stock at $100 and you set a stop loss at $95, if the stock price drops to $95, your stop loss order is triggered and it becomes a market order to sell. So it's going to get you out of the position if it goes down $95, and now it's going to limit your loss instead of you holding and holding and holding until it goes to fucking zero. Position sizing. This is arguably the most crucial risk management technique. Position sizing is determining how many shares, contracts, or units of a security you will trade based on your account size and your predefined risk per trade. So for example, a common rule of thumb is to risk no more than 1 to 2% of your total trading capital on any single trade. If you have a $10,000 account and a 1% risk rule, you should not set up a trade where your potential loss from your entry to your stop loss exceeds $100. Now, I tend to have a more aggressive stance on this. I like to risk 5 to 8% of my account on each trade. This means that if I lose 12 trades in a row at 8% risk, I'll blow my account. But my strategy, after backtesting over 1,000 trades, has about a 70% win rate. So the probability of a strategy with a 70% win rate losing 12 trades in a row is 0.000000531%. So that's really, really, really small, and that is why I'm comfortable risking 5 to 8% per trade instead of the common rule of thumb of 1 to 2%. Here are some more risk management tools. The first one is going to be the give back rule. This is going to be to protect your profits. So if you're already made money on the day, this is going to protect you from giving it all back. So if your daily profits decline by a certain percent, you must stop trading for the day and close all of your open positions. This rule is designed to prevent you from giving back hard-earned gains by making emotional decisions and trades. Daily loss limit, limiting losses. So decide in advance the maximum amount of money you are willing to lose in a single day. If and once you reach that loss threshold, you must immediately stop all trading activity for the rest of the day, and this is going to protect your account from catastrophic losses and blowing it all in one single day. If you have a bad day, you want to limit that loss so you come back the next day with plenty of capital, and you'll come back with a level head instead of over trading and trading emotional. Limited trades per day. This is going to help with over trading. So based on your trading strategy, set a strict finite number of trades you will take each day. This rule is going to prevent impulsive and low quality trades that often result from boredom, greed, or trying to force an outcome. Lesson 3, the psychology of trading, overcoming emotions. Trading and investing are highly emotional activities because of the psychological connection we as humans have with money. The two most common emotions are fear and greed. Fear can lead to selling winning positions too early or holding on to losing positions too long, hoping they'll recover. Greed can lead to overtrading, taking excessive risk, or holding on to winning positions too long only to see the profits disappear. Recognizing these emotions is the first step, and sticking to a disciplined plan helps to mitigate their negative impact. The importance of discipline. It is the most important aspect of a trader is their discipline to stick to the rules, the risk management rules, and their trading strategy. Successful traders and investors are disciplined. They stick to their trading plan, manage their risk, and don't let emotions dictate their decisions. Discipline allows you to execute your strategy consistently even when facing losses or uncertainty. Lesson number 4, building a trading plan. Defining your goals. What do you want to achieve with your trading? Is it long-term wealth accumulation, supplemental income, or something else? Clear goals provide direction. Strategy development. What approach will you use? What strategy will you use? And what are your criteria for entering and exiting trades? And that brings me to entry and exit criteria. This involves setting specific rules for when you will buy a security and, equally important, when you will sell it. This is going to maximize your profit and limit your losses. These should be predefined and not decided on the fly as you're in the trade. The last thing is going to be record keeping, otherwise known as journaling. You have to be journaling your trades. So maintain a detailed trading journal. Record every trade you take, including the date, the entry price, the exit price, the reason for the trade, the profit or loss, and the lessons you learned. And also, I want to add, you should have your emotions before, during, and after to kind of evaluate what makes you go until what makes you make emotional decisions. This data is invaluable for reviewing your performance, identifying patterns, and improving your strategy over time. So that is it. You're pretty much done with the course. We're just going to go over some recommended brokers, and then I have some more value at the very end. Recommended brokers for options trading is going to be Robinhood and Webull. Robinhood is known for its user interface and easy-to-use platform, making it a popular choice for beginners. It offers commission-free trading on stocks and options with a simple fee structure. Note that Robinhood does not offer paper trading. So if you're trying to paper trade, I would recommend Webull. Webull is a platform that strikes the balance between a user-friendly interface and more advanced trading tools. It provides low commissions and a transparent fee structure. Webull does offer paper trading, which is a great way for new traders to practice. For futures trading, I would recommend NinjaTrader and Interactive Brokers. NinjaTrader is a robust platform favored by active futures traders. It offers a highly customizable interface, low fees, and excellent customer service. A key benefit for new traders is the ability to use its simulated trading environment, otherwise known as paper trading. Interactive Brokers is another powerful broker. It's known for its vast array of tools and products, making it ideal for more advanced traders. While it can be overwhelming for beginners, it is known for its low fees, strong backtesting capabilities, and reliable customer support. I personally use Robinhood for my options trading and NinjaTrader for my futures trading. I started options trading on Thinkorswim, now Charles Schwab, and then I went to Webull, and now I'm on Robinhood. And I started futures trading with prop firms. I started with Apex, then I went to Take Profit, and now I'm only trading live account, and I'm on Ninja Trading doing that. That is the end of Module 4, and you are completely done with the course. But you still got to take a test, and I have some more value for you at the end of this. So this module was arguably the most important one. While it's exciting to talk about stocks, options, and futures, the reality is, without a solid understanding of risk management, your journey will be short-lived. Today, you've learned the golden rule. Protect your capital first. You now understand the role that risk management tools play in limiting losses, how emotions like fear and greed can impact your decisions, and the importance of trading psychology, the value of a trading plan as your roadmap in the markets, and that paper trading is your best friend when you first start. Remember, this is not the end of your education, but rather the very beginning of your journey. The key to long-term success is to continuously learn, adapt, and refine your skills. Now, let's take the final exam. Now, similar to the quizzes, I'm I want you guys to pause this, get your answers, write them down, and then we'll go over them. Part 1, the stock market. This is going to be going over module 1. There's only 3 questions per module, so it's super short and super easy for you guys. Number 1, a stock represents what? B, a piece of ownership in a company. Number 2, the primary purpose of an initial public offering is for a company to what? To raise capital for business expansion. B. Number 3, if you sell a stock for more than you paid for it, the profit you make is called a capital gain. C. Part 2, options trading. A key difference between an options contract and a futures contract is that an option contract gives the buyer the right, but not the obligation, to buy or sell, whereas futures contracts, you are obligated to buy or sell. Question number 5. You are bullish on a stock and believe its price will increase. To profit from this movement, you would likely buy a call option, because remember, you buy calls when you think the price is going to go up and buy puts when you think the price is going to go down. Question number 6. The price paid for an option contract is known as the premium. Exactly. Now this is module 3 and 4. Once again, pause this video, get your answers, and we'll go over them. Question number 7. In futures trading, the small amount of money you must deposit to open a position is called the initial margin. Question number 8. Which of the following statements is true about futures contracts? It is C. They are settled daily through a process called mark to market. Question number 9. The most significant risk in futures trading is due to high leverage, which can magnify both gains and losses. It is D. You can take very, very high losses in futures because you're leveraging so much capital. Now, last 3 questions in the final exam. Number 10, a stop loss order is a tool used primarily to limit a potential loss on a position. Question number 11, the practice of determining how many shares or contracts to trade based on your account size and risk tolerance is known as position sizing. Exactly. Question number 12, why is a trading plan and good risk management considered the most important part of trading? It is C, because they help protect your capital and ensure you can stay in the game for the long run. Now here's an answer key for you if you want to take a screenshot of this. And this is the end, but I do have some more value for you, so stick around. But I just want to say you have successfully completed the beginner's course in the financial markets. Take a moment to reflect on everything you've learned. You've learned the basics of stocks, to the complexities of options and futures trading, and how to manage your risk. So final notes, remember, this isn't truly the end. It's the beginning of your journey. The foundation you've built here will serve you well as you continue to learn, practice, and grow as a trader and investor. Without the discipline to follow your plan and your rules, you won't go very far. Successful traders are not afraid of losing money, they're afraid of losing their discipline. You need to be a continuous learner. Even traders 10 plus years in are constantly expanding their knowledge and adapting to new market conditions. Now, you can join my Discord server to get access to more free resources, and for those of you who are more serious and are ready to make serious money, there's a VIP version with tons of additional value to help you reach your goals. Now, I just want to say I did not make this course just to try to get you guys to join my Discord. I genuinely want you guys to succeed in trading, and I am here to help. This is why I have a free version on my Discord and why there's a free version. But for as much work as I put into it on everything else in the VIP access, I just can't give that value away for free, which is why there is a VIP version. But if you want to get started today, there is a free version, and there is enough value in there for you to literally get started today. So the free version will include full video courses, so access to this beginner's course, obviously, and my basics of technical analysis video. It'll give you access to certain live classes that we do, so we'll occasionally host free lives, and we'll give you a sneak peek of the analysis and trade plans that our paid members receive every single day. And we'll also host classes going over risk management, psychology, and we'll occasionally post those for free. There'll be a motivation and insights channel. So this will provide motivational content and key insights to help you build the discipline and focus of a professional and give you the real raw side of trading. So we're not going to sugarcoat things. Trading is really hard, and we're going to tell you that straight up, but we will give you everything you need to be successful. And I'm sure you guys have heard 95% of day traders fail, but that is because 95% of day traders quit and they don't make it far enough, they don't work hard enough. But I promise you, if you work hard enough and you're disciplined enough to stick to your rules, stick to your strategy, you can make a shit ton of money day trading. Now you will also get the trading chat in our free version, but this will be view only just because we don't want it to be cluttered with messages from people in the free version. We want more serious people in there being able to send messages, images, videos, our reactions, stuff like that. So it's a place for our VIP members to share their insights and ideas, ask questions, and connect with other like-minded people who are committed to becoming professional traders. We also have a long-term idea section in our free version, and this is a lot of value. Here we send any stocks we like for the long term. These are companies we plan to buy and hold for over a year or more. Your long-term portfolio is where serious generational wealth is created, whereas trading is for steady cash flow. So you make cash flow in trading, and you can funnel that money into a long-term investment portfolio. Now, you will not get access to our daily watch list, our live day trading signals, our swing trading signals, no access to our trading strategy. Obviously, that is super valuable. We cannot give that away for free. No access to VIP exclusive live classes and Q&As, and no ability to engage in the trading chat channel. Now, in the VIP access, you will get our daily watch list, which is access to our watch list every morning with the most precise levels for both futures and options. You also get live day trading signals. So it will unlock real-time trading signals. Every time we take a trade, we will signal it to our members. You get to see our entry, our stop loss, and our targets. This alone holds 10x the value of what we charge. By the way, to see what we charge, just go on WAP. There'll be a link in the Discord under Get Access. So the ability to copy our trades is nice in the beginning, but our goal for you guys is to learn how to fish, not just eat the fish. So we want to teach you guys how to trade, not just copy our trades. Swing trading signals. So we'll have a channel for our swing trades. You'll be able to see our full detailed analysis, including our reasoning, entry, stop loss, and targets for any swing trade we enter. This is an ideal channel for those of you who work throughout the trading day, so you can't be there to day trade, but you can still make some serious gains by swing trading. Full breakdown of our trading strategy. Unlock my complete trading strategy video and get access to all live classes that provide even more in-depth detail on the strategy we use. So I'll have a full breakdown of our strategy that we use and we implement every single day, and you'll get access to that. Exclusive live classes and direct Q&As. To gain access to live classes covering crucial topics like risk management and trading psychology and many, many, many more. Plus, get your questions answered live by us in real time. And finally, the trading chat. You'll have the ability to send messages, images, videos, and our reactions in the trading chat. Here you can share your insights and ideas, ask questions, and connect with like-minded people. You can connect with other traders who are just getting started just like you. You can really build a community, and that's what we're here to do. Plus, you get everything in the free version. Once again, the price for that will be in the Discord under Get Access. If you want to take a screenshot of this slide, this will have everything in the free version versus the VIP access version without the description. And that concludes the beginner's course. You guys did it. It was a long course, but you have all the basics now. You know what a stock is, you know what options are, futures, and you know a little bit about risk management. Now we go into much, much, much further depth in our live classes. You will get a lot of value just being in the Discord, even for free. So give it a look, stay active. You can really make a shit ton of money on this, but you have to be willing to put in the work, and you won't make a shit ton of money within a year. You'll probably lose money within the first year. And now if you're copying our trades, you won't. But you will not be a profitable trader on your own within a year, even 2 years. It takes time, and that's why only 5% of traders actually are profitable in the long run. But that's also why once you become a profitable trader, the benefits to it are unlike anything else, unlike any other job you could ever have. And that's why we built this Discord, so we could bring it to you guys, and we want you guys to make money with us. Now you could say, if they're making so much money, why are they making a course? It doesn't make any sense. They make a shit ton of money already. Well, we're not making this course to make money. We're making this course to help other traders make money, right? And then you could say, then why are you charging? Why aren't you making it free? Because it is a shit ton of work for us. We have too much value and too much time put into this to charge nothing. That'd be insane. And plus, who doesn't want to make more money, right? If you had that ability, you would do the same thing. But at the end of the day, we're doing this for you guys. We're not doing it to take it from you guys. So, congrats on completing the course. Join the free Discord if you're really interested in leveling up. Join that VIP access, and we'll get right into everything.